Why does a 5-year forecast matter? It's not random. In CFA exams, the horizon must capture the most important value driver. I'll show you exactly how to spot it. Question 2. An analyst is valuing Meditech Solutions and calculates the terminal value using a price earnings (PE) multiple based on the company's 5-year historical average. The analyst's supervisor points out that a competing firm is in the late stages of developing a disruptive technology that could make Meditechnician's core product obsolete within the next decade. To account for this risk in the terminal value calculation, the most direct adjustment would be to A. Decrease the PE multiple. B. Lower the perpetual growth rate assumption. C. Increase the beta used in the cost of equity. Correct answer: A. The PE multiple gives us a peek at what the market thinks about how Meditech will grow and make money in the future. If Meditechnician's main product is on the verge of being replaced, it's probably going to have lower earnings and growth than it used to. A lower PE multiple would naturally reflect this lower expectation of future performance, making sure the valuation matches the new risk level. This is the easiest way to adjust when you're using a multiple-based approach. The PE multiple is a quick way to see how the market thinks a company will do in the future. If there's a chance the company might become outdated, the market should lower the multiple to show that earnings and growth might not be as good as they seem. This change is straightforward and fits with the way we're valuing the company using multiples, and it takes into account both how much the company is expected to grow and the risks involved. Be incorrect. Lowering the perpetual growth rate is a direct adjustment in a DCF model, but not the most direct correction for a multiple-based valuation methodology. C. Incorrect. Adjusting the PE multiple directly is more appropriate than increasing the required return via beta when considering obsolescence and risk. Question 1. An analyst at Horizon Capital is building a financial model for Neuralink Labs, a biotechnology company. The analyst must choose an appropriate forecast horizon and considers 3 factors. Factor 1. The average holding period for Horizon Capital's growth portfolio is approximately 4 years. Factor 2. Neuralink's lead drug candidate is in phase 3 clinical trials, with results expected in 3 years and potential commercial launch in 5 years if successful. Factor 3. Neuralink recently sold a non-core diagnostic division, which represented 3% of total revenue. Which factor best justifies using a 5-year forecast horizon for Neuralink Labs? A. Factor 1. B. Factor 2. C. Factor 3. Correct answer: B. The 5-year timeframe is perfect for when Neuralink's top drug candidate might hit the market, which could really shake things up for its revenue, profits, and cash flow period. This is the moment we are all waiting for. When you're making financial models, it's super important to think about big, game-changing events, like when a product launches or gets the green light from regulators. A 5-year view makes sure the model captures the initial buzz of this drug's success, or if it doesn't quite work out. For biotech and pharma companies, the real treasure is in the pipeline, milestones, especially those late-stage trials, phase 3, and when they start selling the product. If you skip this, you're missing out on a huge part of the story. The forecast should think about what's important for the company, like when new drugs get approved or launched. Go far enough to show how strong our earnings will be after the event. Don't end it too soon just to match someone else's time frame, unless it leaves out what really matters. A. Incorrect. A 4-year holding period for Neuralink would miss the drug launch's financial impact, resulting in an incomplete valuation. B. Incorrect. Divestitures of minor divisions have a negligible 3% revenue impact, unlike the significant impact of a successful drug launch.